Welcome to Dukascopy TV. The world of oil is volatile at the moment, and to give us his reasons into why this might be is Bob Pillar from the Geneva School of Business Administration. Welcome, Bob.
Thank you. Nice to be here.
So let's talk about geopolitical tensions. There is a lot going on at the moment, and usually we would see prices rise, but they are quite low. What are the reasons?
Well, after a period of stability over the last several years, stability if high oil prices, we've seen them drop tremendously, 40% or so in the last 6 months. And there's lots going on. The old curse, may you live in interesting times. So these are definitely interesting times in oil. And there's a confluence of reasons. And despite some of the geopolitical things one would expect, such as the tensions with Russia, a major oil producer, it probably really comes back to the age-old supply and demand. And the trump card that has entered into the oil equation over the last 3 or 4 years is the U.S. shale oil production, or the non-traditional oil, which has, the United States has increased its domestic production by 50%. They're up to 9 million barrels a day, and this is having repercussions throughout the entire oil world. And there's this tremendous supply coming into the market, and people are reacting to that. OPEC was expected to cut production. That's often the role they have played. The last several years, OPEC has been quiet because they were relatively happy with the stable oil price being high. Some people were expecting them to react as they had traditionally, particularly the Saudis being sort of the swing producer. But they decided a couple of weeks ago to let market forces dominate. And it seems that what's behind that is really to try to affect or to diminish the capacity of the high-cost producers, and the high-cost producers being the non-traditional producers, the shale oil, the Canadian oil sands, and to have them bear the brunt of any potential cuts. They don't feel that they should. There's also the idea of perhaps maintaining market share. The Saudis want to maintain their share of, for example, the Asian oil market. So that's the one side on the, so we're flush with supply. On the other side, one has seen a diminishment of growth in China. China's still growing, but at a much slower pace than it has. So anticipated demand has been less. So you have some classic, say, supply factors, some demand factors, and this has led to a period of unusual oil movements downwards.
Benefit for the consumer?
As always, people, they're winners and losers. Consumers are winners. Someone said that the play this year was to have been short oil and long transportation stocks. So the winners, consumers, airlines, people like that. Losers, producers, the majors who've seen their stock prices drop 3–4% in the last week or so recently, and had other drops before. So yeah.
Well, we're talking about the US. I mean, they've opened a refinery in Texas not too long ago. Can it be a worldwide contender, or is it actually too expensive to run?
Well, the U.S. again, the shale oil story in the U.S. has been very dramatic, and up until that happened, refineries have been a difficult business to be in, and many of the majors have exited or are exiting from their refineries, both in North America and in Europe, where there's been overcapacity generally. Demand has fallen again for oil products since the financial crisis. Things have been shifting to Asia with the construction of large, huge refineries that have tremendous economies of scale. So it's been a bad business to be in. But then in the States, again, the shale oil revolution has created such supply that the refineries are able to take advantage of that and have a very low feedstock prices compared to international prices. The particular dynamic in the States, of course, is that it is there is a ban on crude oil exports. So whatever the States produces is basically trapped in America, which is one reason why there's sort of a filling of the tanks, storage tanks in America. So the refineries have benefited overall. They've been able to produce product. There's been an increase in U.S. they can't export crude, but they can export products. So the refineries along the Gulf Coast in Texas and Louisiana have probably had a better time of it in the last couple of years than they had for a long time. Whether that will continue, that's always the question. When will that rebound back? Yes.
Well, talking about when it will continue, do you think then that the price might actually stabilise next year?
Well, they will at some point. Again, there's winners and losers. Some people like volatility, others don't. Some people want stable prices, but oil traders, for example, do like volatility because it can add to their returns. Traders do not typically like stability. It's harder to make money for a trader, but you have traders, producers, consumers. They all have their different perspectives on this. I'm actually wary to actually say when or how this is going to happen. I think the key issue is obviously how low can it go. At the present levels, which is now below $65, you have the high cost producers such as the Canadian oil sands and again the shale producers are very high cost, between $70 to $80. Then you have some of the traditional producers in the States are around $50. Saudi Arabia is the low-cost producer, somewhere probably around $25. So how far can the oil price go? Kind of depends. But at some point, the market needs to support a level of an oil price. Obviously, there's already considerable reports of the majors and others restricting and reducing their investment plans. And you can see the beginning of the next cycle where if investment is diminished, that will only create perhaps potential supply deficits in the future when demand again increases. So you can see that now. How long will this situation last? I think to some extent it's kind of a game between, I would say, some of the oil producers who are state-owned, such as the Saudis, who something on 80 to 90% of oil reserves are owned by governments, by the states. And they tend to be among the low-cost producers in the world versus the private companies, particularly the ones in North America, who tend to be on the high side. So investment in oil is increasingly becoming more expensive. The easy oil has been found. There's not a lack of oil. The only question really is, what does the oil price have to be to give an incentive to go get the oil that's there? So the new oil that's being discovered is going to be very high cost, so at that $70, $80 range. It's only going to get more expensive over time. So at some point, the oil price has to, over time, support that. But right now, people, I say, it seems to be this state-owned oil companies, trying to force the privately owned companies to take the brunt of any potential cuts. I'm not going to predict. And we can see, the reason I don't necessarily want to predict how long or when is because it's impossible to predict. No one predicted this. No one predicted oil was ever going to fall below $80 or even $70, and it has. 3 or 4 years ago, no one predicted the effect of the shale oil boom. That was, the majors were not behind that. They were smaller, medium-sized companies who developed that. So that sort of came out of nowhere. Don't know how to predict, but
so just wait and see.
Just wait and see. I mean, at some point, I think it's going to have to recover at some point, But will it go back to 100, perhaps 80? That would seem to make economic logic. But I'm not so sure we're in a situation of economic logic at the moment, given the behavior of some people in the market.
Well, thank you for coming in to give us your reaction to the marketplace.
No, thank you very much for having me again. My pleasure.
Well, that's all we have time for today. Make sure you keep checking back in with Dukascopy TV. Goodbye.